is Tara Tillman of Westchester Realty, and today we have the most exciting episode ever. We are talking about the Kiddie Condo loan, or as it's also known, the non-occupying co-borrower. We also have Dana Meadows from Movement Mortgage. She knows everything about everything. Her information will be in the description. And so let's get started. Hey, Dana, how you doing today?
I'm great. How about yourself?
I am wonderful. Well, to kick this off, I guess we should explain what the so-called Kiddie Condo loan really is.
Absolutely. The
Yes.
Kiddie Condo, that is a term that's not a real term. Any lender will tell you that that program does not exist. But what a parent can do when a child is in college, instead of renting an apartment for the child, they can help the child become a homeowner. So the child can apply as the primary applicant, and the parents can be the non-occupying co-borrowers. A lot of people use the terminology co-signer. We don't want to do that in this situation because the parents are going to want to have ownership in the property. So they would go on as a non-occupying co-borrower, and we would use their income and their assets to support the mortgage, provided that they did so.
Now, when you have a buyer who is an investor, this is a great way to get an investment property with a low down payment, with very little outlay, right? So you're not going to have to pay 20% down because you're putting your student in college. There are a couple of ways that you're going to benefit. Number one, you're not going to be paying a whole bunch of money in dorms, right? That's the first thing. But secondly, you're going to be able to get an investment property. So tell us about how we can get this investment property with, 3.5% down, maybe using FHA or a conventional loan.
So basically, as long as the child credit qualifies, we would put the child in primary position on the loan. They're the occupant of the home. And that would allow anywhere from 3% down on a conventional loan or 3.5% down on an FHA loan. The parent would go on as the non-occupying co-borrower or second applicant, and that could be just mom or just dad or mom and dad, utilizing their income and their assets to support the debt to income ratio requirements and the funds that are needed for closing. And by being non-occupying co-borrowers, the child and the parents are on the loan together. They're also entitled together. So the parents can't sell without the child signing, the child can't sell without the parent signing. But it is a great way to possibly save money on housing expenses while the child's in college, and then have something that they can maintain for future rental income or sell for future profit.
Now you mentioned credit, right? So we're talking about the credit of the child as well as the credit of the parent. They're going to use the lowest credit score in determining the credit, right? So what is realistic in terms of credit for the student and the parent, and how will that play in terms of, I guess, interest rates or whatever? I'm assuming that's what's going to be affected on the credit side.
Absolutely. So first, FHA is going to be the most forgiving for any type of lower credit score, which we tend to see with young credit borrowers. Most of these kids going into college have never had any credit or have just opened their first credit card while they're in school and maybe have not, maybe they've overcharged on it or maybe missed a payment. So we do have to look at the child's credit. So the minimum for FHA is 580, but that does not guarantee approval. Just because the guideline says this is the minimum credit score does not guarantee that we can close the loan. So a parent with higher credit scores could be a good compensating factor. A parent with a lot of assets, whether that be checking, savings, money market, retirement, stocks, the more assets, that's a better compensating factor. And sometimes a larger down payment, a 5 or a 10% down payment on an FHA loan, will help get an approval with a 580 credit score. If the child has no credit score, we can do a manual underwrite to see if compensating factors will allow for an approval. But that is, the computer is not going to dictate whether or not we can close the loan. It's going to be in person in our underwriting department.
So then I'm assuming that it will be very, very helpful if you're thinking about trying to do this with your child, that you would work on their credit up front. Meaning, if they have no credit, of course, you can always add them to a credit card or help them to establish credit so that when you're ready to move in that direction, they're prepared to have maybe even a higher credit score than yours at some point, right?
Absolutely. And just keep in mind, just because you add a child to a credit card, if some of them don't ask for the child's social security number. So if they're not asking for a social security number, it's not a guarantee that it's going to report to the credit report. If they do ask for the child's social security number, it will absolutely report to the credit report. So
And so
just
that's
keep
what
that
you
in
want.
mind.
Yeah, and that's what you want. So maybe, let's say you're buying your kid a car. Maybe you put them on the loan to the car as well. What are the best ways to build credit for your kid?
Well, helping them establish credit accounts for the first and foremost. When you add a child as an authorized user on a credit card, they get your entire credit history on that account. So if you've had that account for 15 years, you pay it in full every month, you keep a very low balance, and it's always paid on time, they're going to reap benefits provided that credit card company reports to the credit bureaus. If you do go help them purchase a car, I'm not certain, but I feel like you might have to be 18 to go on a car loan. I could be wrong because that's a different industry. But let's just say you're buying them a car to go to college, you plan to finance that car, go have them go on the loan and you go on the loan with them. So they're getting the benefit of the on-time payments that you're making or they're making while they're in school. One thing that I'm very frustrated about with our school systems is they don't educate children how to be financially smart and how to take care of their finances. I know we're in North Carolina, but the state of South Carolina just passed a requirement that be a class that every child take before they graduate from high school. And truthfully, in a lot of areas of the country, the parents don't even know how to guide their children because nobody ever guided them.
No.
So it's very important that your children understand that starting out, how they start out is going to affect their ability to purchase anything down the road.
Now, what is that going to affect debt to income ratio though?
Yes, absolutely. So if, let's say, you co-sign with the child on a townhome in Raleigh at UNC, or no, that's not UNC, that's
Chapel Hill
No, well, let's just use Chapel Hill.
or a state?
NC State, that's what I was looking for. So let's just say you co-sign or you go on this loan to buy this townhome in Raleigh. And the child graduates, gets their full-time job and is ready to go. Let's say they're moving to South Carolina. So they want to purchase a home in South Carolina with their new income. We're going to have to look at that mortgage payment when we're qualifying them for the next home. Likewise, if you are a non-occupying co-borrower on a child's loan, if you go to purchase another home, we have to take that payment into consideration. Now, a lot of people will buy properties for their children and then they get roommates and there's rental income that comes in. Keep in mind, whoever's tax returns that rental income is filed on is who gets to get credit for the income when they go to purchase another property. So that is the one thing to keep in mind.
Yeah, that's what I was going to talk about next, is how exciting it is to be able to have that rental income to offset the mortgage. But even so, wait, so let me back up. Your kid only has to live in that property for a year, right? A year.
Anytime there is someone that is purchasing a owner-occupied home, whether you're being a co-borrower or not, you are signing as the primary applicant that you will be living in the home for at least 12 months. So the child lives there their senior year of college and moves on out, that's okay. But just keep in mind, if the child's not the one claiming the income on their tax returns, when they go to purchase their next home, we're going to count that mortgage liability against the child.
Okay, so let's say that the child has moved on, they're getting ready to go to grad school. And you want to apply this method again. But you already have filled the property with renters. So now that mortgage is covered, for the rental income. And is it then possible to move on and do it again? Because if I have a property that's rented out typically, right? And I go to buy something else because it's rented, that sort of covers that portion of the loan so that it's not necessarily counted against me. Is that the same in this particular situation?
Yes, I mean, we can use rental income to qualify for a future purchase. A buyer can have up to 10 finance properties. And as long as they have the child lived in there for a year, they can turn it into a full-time rental and then move on and do it again. But just keep in mind, every time that happens, you have to be careful so that your child has the ability to purchase their own home when it's time. Because
Okay, so
if you do that multiple times with the same child and they're not claiming the rental income, it's going to be a detriment to their ability to purchase in the future. So you have to keep in mind the win-win for you from an investment property standpoint and the detriment that it could also cause the child when they're ready to purchase if they aren't able to qualify.
you did it for the first one on yours, but then you get the second property, your kid could be claiming that.
Correct. You're not leaving the child to qualify by themselves with no rental income. So that's just the one thing you have to keep in mind. The only way around that is to file an LLC and have parent and child being owners of the LLC and run everything through the LLC in a corporate return. But what you have to be very careful of is if in your note, there's fine print that says if title changes, we can call the note due. And if they call the note due, you have to pay that mortgage off. So now the government agency has to find out that you changed title, which is unlikely, but you need to be prepared that that could happen.
Gotcha. So in this FHA scenario, there is mortgage insurance, right? Now it's consistent throughout the life of the loan. Is that true?
With a minimum down payment, yes, the mortgage insurance is permanent for the life of the loan, and it has been for a very long time. Now that's with a minimal down payment. It can be eliminated as long as the initial down payment is 10%.
Okay.
And once it's paid down to the 20%, it can be eliminated. But I also want to reference, if you're looking at this 6, 12, 9, 18 months down the road, these guidelines are subject to change at any time. So I'm giving you information based on today and not what the future may be.
Gotcha. And in this same scenario, gift funds can be used for down payments, closing costs, and to pay off debt. And, in order for the kid to get approved or you to get approved. And can we use seller paid closing costs? Because as I understand it, yes, we can, which makes this a very, a great way for you not to have to come out of pocket a total of 20% to buy an investment property.
Yes, so if it's an FHA loan with a child in primary lien position, it's 6% of the sales price and closing costs can be paid by the seller. And then if it's a conventional loan with a minimum down payment, 3 or 5%, they're limited to 3% of the sales price.
Okay, so we can do this not with FHA, but also with the conventional loan and not have to pay mortgage insurance at all?
Well, there's still mortgage insurance if there's not 20% down. But the mortgage insurance on a conventional loan could be eliminated once you pay it down to the 80% of the original sales price.
Okay, so let me be clear. You can do a conventional loan with this same program with only 3% down.
Correct.
Correct. Okay, so then the other question I have is, I know that if you purchase a HUD property, a 1 to 4 family unit HUD property with an FHA loan, then you're only required to put $100 down. You can do a 203K renovation loan to renovate that property. Can that same program be used with this non-occupying co-borrower program?
Yes, it can.
Wow. So you mean that as a parent who wants to maybe get an investment property, I can buy a property, a 1 to 4 family. Okay. So if I go up in the number of units, so I'm clear about one family. What if I wanted to get a duplex or a 3, 4, and have my kids staying in one, and then I'm renting out the other 3? Is there a higher requirement for down payment or anything that would change the scenario?
No, not at all. So just keep in mind, the child has to be the primary applicant on the loan. As long as they're a primary applicant, there's not a higher down payment requirement.
Okay, and then, but that still puts the burden basically on the parent to have enough income to be able to afford the property because, a college student is not typically going to be bringing in the kind of money that would support that kind of purchase, right?
Correct.
How does the potential rent offset qualifying income?
We cannot use potential rental income to qualify on an on an owner occupied transaction. So we cannot look at projections for someone else renting a room or another unit to qualify because this is an owner occupied transaction.
Okay. So it can't be.
Except for the multiple units, you can, because we can look at projected income on multiple units, but not on a single family home. We can't use it as
Gotcha.
rental income.
So on a 2, 3, or 4, you could actually do that.
Correct.
So is there anything else that you can think of about this particular program that we should know that I haven't asked because I'm not knowledgeable enough about your job to ask this question?
No, I mean, I think we've just covered all of it. The majority of what this topic, we've given the information that would guide parents and how to, help their child build, some financial wealth through having title to the property, helping them possibly get some rental income in the future. But it's a great way to approach investing in real estate as long as you can support the entire transaction with the child on the loan.
Dana, tell people how they can get in touch with you and a little bit about who you are and what you do and, your office and all of that.
So I've been in the industry for 18 years. I have been with Movement Mortgage. This September will be 10. And I am one of the #1 producers in our company. Last year, we helped a little over 700 families with their mortgage needs. I have a large team and support staff that works with me to make sure that every client feels like they're our only client. And to get in touch with me, my cell phone is 704-763-9728. And my email is dana.meadows@movement.com.
Now, if somebody is watching this and they're outside of North Carolina or South Carolina, does Movement Mortgage do loans in other states? And if so, how would you be able to bridge that gap for them? Will you give them a referral to somebody else, or, how would they be able to do that?
We are a large national company, so I have connections with top producing loan officers throughout the country, but I myself am licensed in North Carolina, South Carolina, Florida, Georgia, Ohio, Tennessee, Kentucky, Alabama, Michigan.
Wow.
And Ohio.
Okay, guys, so no matter where you are, no matter where you are, you can call Dana and she can help you. Listen, she is my go-to. If I have a question about anything, I reach out to Dana, and no matter when I call her, she is always getting right back to me. There's never been a time where I've waited more than 24 hours to hear back from her. If I've ever asked her a question that, she was like, let me check just to make sure, she'll check just to make sure and get right back to you. So give her a call.
Thank you.
Dana, thank you so much for being here with us today. Thank you so much for being a part of this and telling us exactly how we can get an investment property with less than 20% down, and also to help our college student and to help ourselves and to help them to grow generational wealth, because this is what this channel is all about. It's about teaching everybody how to build generational wealth through real estate, because it is the #1 way to do so. So again, thank you. That's all we have for this time. Once again, I'm Tara Tillman of Westchester Realty. You can reach out to me at 336-299-4040. And please like and subscribe to our channel and share this information with someone who might benefit. I hope you guys have a blessed day. Until next time.